name is Jerry Yu, the Family Money Doctor. I have been a retirement specialist and tax strategist for more than 20 years. And life insurance planning is one of the most important and fundamental family planning tools. We all know that properly designed permanent life insurance can provide family protection. Also, it can be a great tool to use the cash value buildup in the policy to provide tax-free income. See, one of the most common questions I get asked about index universal life insurance policy is, how can insurance company provide 0% floor protection and generate interest when index produces positive return? How does that work? When you pay your life insurance premium, a small portion is to pay for the cost of maintaining the death benefit. Majority of the premium is going into index calculation account to generate cash value. Nowadays, life insurance companies provide multiple index options for client to choose. Or a client can blend multiple indexes for diversification purposes. One thing I wanted to emphasize, and this is the key, the premium that is in the index interest account is not directly invested in any selected indexes. This is a very important concept, and let me repeat it one more time. For index universal life insurance policy, the premium is not invested directly in any index. The index calculation is based on selected index using 1 year or 2 year point-to-point differences to calculate the interest. See, for example, if the differences in the selected indexes 1 year point-to-point result is negative, the index universal life insurance policy has a guarantee of 0% floor protection. But the key is the policy owner will not lose cash value because of negative point-to-point result. And if the selected index is 1 year point-to-point differences is positive, the policy owner will gain interest up to the cap or calculated with the participation rate. But many clients do not understand why index universal life insurance policy can provide 0% floor and have interest if the point-to-point is positive. In fact, this concept is very simple. I will explain with 2 examples today. Before I share the concept, I would really appreciate it if you can hit the like and subscribe buttons. It will help me to increase my YouTube traffic flow, and I really appreciate your support. Let me first talk about how the insurance company achieved the 0% floor guarantee. One thing I wanted to remind everyone is that all the numbers and math are only for illustration purposes to help you understand the concept. And let's look at this chart. Assuming the insurance company receives $100 premium and it has taken out all the costs and charges, okay? With this $100, if the insurance company knows the 1 year investment such as the US government bond offers a 5% interest, insurance company will allocate approximately $95 to the 5% government bond. After 1 year, $95 times 5% interest, the insurance company will have $100 back. This is the base of 0% principal protection concept. Let's say the short-term government bond offers interest of 3%. The insurance company can just allocate approximately $97 to the government bond, and $97 times 3% interest, 1 year later, insurance company gets back the principal plus interest of $100. And this is the concept of 0% floor guarantee. As you can see, it's not hard to do. Now, regarding the index interest, when the insurance company receives $100, allocated $95 to protect the principal, insurance company can use the remaining $5 to buy the 1 year or 2 year point-to-point index options. We all know the risk of option is very high. But when the insurance company has taken $95 to protect the principal, using the remaining $5 to buy index options, if the 1 year index option is positive, client will get the interest credited to their cash value account up to the cap or calculated with a participation rate. But if the 1 year index option is negative, the $5 is gone. But client do not need to worry because insurance company already protected the principal. See, clients simply do not have interest for that 1 year. Some client might say, Jerry, I don't understand how index option work. Sounds complicated. Please see this picture. I'm going to use real estate to explain how to generate market return. See, this is only a simple math illustration. I'm not going to consider the cost of ownership nor any applicable taxes, okay? The simplest way to make a profit from real estate is that I pay $1 million to buy a house. A year later, I sold this house for $1.1 million. How much did I make? $100,000, right? So that is a 10% return on my investment for 1 year. That is not bad return, isn't it? Now, let's look at the second way to generate positive return for real estate. Suppose I saw the real estate construction. I went into the builder's sales office to look at the model home. After seeing the model home, I like the particular house with the big yard. The selling price for that house is $1 million. And it will take 1 year to build. So the sales manager told me I only need to pay $20,000 deposit today to secure the right of that house, which I did. 1 year later, the construction is about to be finished. A stranger saw my house and liked it very much. He went into the sales office to inquire about my house. The sales manager says, "Oh, Mr. Yu owns the rights of that house." Then the stranger found me and asked if I was willing to transfer the rights to him. As a savvy investor as I am, I say, hey, everything is for sale at the right price. And I told the stranger that the current market value of that house is $1.1 million. Do you want to buy at $1.1 million? And the stranger says, okay, deal. We went into the builder's sales office. The stranger paid me $1.1 million. And I paid $1 million to the builder to complete the title transfer. For the sake of keep it simple for this transaction, okay, I made $100,000 from this transaction, which is not bad. But what is my return on this investment? Let's see. I only pay a $20,000 deposit and 1 year later made $100,000. So the return on this investment is 400%. That's very good, right? So this is an example of using option to make money. Do you think this is a risky investment? See, I'm using these two concepts to show you how easy it is for insurance company to offer a 0% floor protection, also using the index option to earn interest. If you want to know more about the detail of how index universal life insurance can earn interest, I suggest you to contact your insurance agent to go over the details one more time. And thank you for watching my video today. And if you think today's video is helpful to you, would you please hit the like and subscribe button? And thank you for your support. And I will see you in the next video.